Good day. I'm Dave Kanya, Wealth Advisor here at Green Wealth Management Group. I'm joined today by Drew Heatley, Partner and Senior Wealth Advisor, to talk about the economy and the markets. Drew, what are you seeing in the economy these days?
Great. Thanks for the introduction, Dave. And thank you for the opportunity to share more about our thoughts on what's going on with the market and the economy. Fortunately, the market and the economy are doing well. The economy is back to its pre-trend growth of 2% real growth, pre-pandemic trend. The economy is back to that growth rate on the backs of government spending and the consumer. The two biggest factors at play right now in the economy are the same as they have been for the last couple of years. It remains the inflationary trend as well as the government's response to that via the interest rate policy dynamics at the Federal Reserve. Inflation, as you can see on the chart above here, has had quite the trajectory over the last couple of years. Inflation peaked in the summer of 22 at 9.1% and currently resides at 3.3% as of the last monthly measurement. It's of course important to note that inflation is cumulative. The cumulative impacts of all of these increases is certainly felt quite a bit by many folks out there, especially those who don't have any assets to feel the beneficial aspects of some of the policy responses to inflation. If inflation remains elevated, and as you can see on this chart, it's been elevated at a 3% plus level for the last year or so, the Fed will likely have to act or find some way to restrict the financial conditions in order to change consumer behaviors to something a little bit more restrictive. If that is indeed the case, then the interest rate environment that you see also here on my left will likely change. The current interest rate environment is sitting pretty much unchanged officially over the last year, as the Fed has not acted since last summer. The federal funds rate sits at about 5.5%. What you also see here is the trajectory of interest rates that is estimated by both the Fed and the market. As you can also see here, it's set to fall quite precipitously over the next 1 to 2 years. But I would note here that all predictions over the last 1 to 2 years about where the path of interest rates were set to head have been woefully wrong, and these are likely wrong also. So take these with a grain of salt, hope for the best, and prepare for the worst.
So, what factors have contributed to the economy's resilience?
You know, Dave, the economy has been quite resilient to, I think, the surprise of many over the last couple of years, and the resilience has come on the backs of what it typically comes on, which is the consumer and the government. The consumer right now is in quite good shape. It has been very resilient because it has been in quite good financial shape. The consumer now has a great balance sheet. The amount of debt right now on the consumer is not very high. This is generally speaking attributable to the average locked-in mortgage being somewhere around 3.8%, despite the current mortgage being a little bit over 7%. That has allowed the average debt-to-income ratio for the average household here in the US to be below 10%. That means that 90% of our income is freed up to be spent on goods and services. That's quite attractive in a consumer-driven economy like ours. In addition to that, we have quite a bit of savings still remaining on the sidelines. And while this isn't necessarily equally distributed across every American, there's still about $600 billion remaining on the sidelines from the pandemic, where we had all this money incoming from wages, from the government, and we had nowhere to go to spend it. That still remains on the sidelines as kind of an economic dry powder, if you will, to be spent at some future date. In addition to that, we also have, and this is the real kicker, what the government has been up to with its spending policies. So right now, the government is spending at approaching a 7% budget deficit. This is basically spending like it's economic wartime when it's actually economic peacetime. There's only been a few other periods in history where we've spent this much as a nation in spending policy. Most notably, the most recent anyway, has been the pandemic. Then previous to that, it was the global financial crisis in 2008. And then you have to go much further back in history to the recovery from World War II to find another time where we were spending 7% plus in a budget deficit. But we're doing it now when unemployment is essentially at a very low rate. And so you could essentially say that tax receipts won't be any higher than in the cycle than they are now. Retail spending won't be any higher than it is in the cycle as it is right now, yet we are spending quite a bit. So what is a sugar high right now may down the road turn into a sugar crash, but for right now, it's working quite nicely in the economy, and I think has contributed to its resilience quite nicely.
With that being said, are there any concerns out there in the economy to be aware of?
Thanks, Dave. And actually, while the economy is generally strong, there are a few concerns out there that are, generally speaking, a result of the aggressive Federal Reserve interest rate hikes that we've had over the last couple of years. That while they haven't really taken grip, they should be made, we should make you aware that they're generally speaking out there. The first, as you can see on screen, is this concept of the leading economic indicators index, which has been negative for 29 consecutive months. And as you can see, dating back many decades, when it has been negative for this many consecutive months, it has typically preceded recession. Additionally, there's the concept of the yield curve. The yield curve is, of course, a measurement of treasury yields from very short-term treasury yields all the way to very long-term treasury yields like 30-year. Generally speaking, I think most folks feel like you should get more interest for longer dated treasuries, and that's normally the case. An inverted treasury yield curve is when you get higher interest rates for short-term yields than you do for long-term yields. The treasury yield curve has been inverted for almost 2 years, and it has been inverted before every US recession. The reason why it's typically a predictor of recession is that it is commentary on the lending environment for banks. Banks typically make money by lending at the long end of the curve, and they pay out on deposits for interest at the short end. So if you're a bank and you're paying out to depositors at 5% plus currently, but you're only receiving 4.5% plus at the long end, well, of course, those numbers don't work out. And you, like many other of your bank colleagues, will not lend nearly as much. And if lending tightens up quite a bit, that's of course a predictor of future economic activity, thus leading to potentially slower economic activity down the road. In addition to that, there's the aspects of the labor market, most notably the unemployment rate. And while the labor market is generally speaking pretty strong, the unemployment rate has actually moved up quietly from last summer at 3.5% to this summer at 4%. And while historically speaking, that move is a relatively large one, the absolute rate is still very, very low, almost at a 50-year low. Just something to take note of in the contrasting to the strengths out there.
So, Drew, given that economic backdrop, how has the market responded thus far this year?
Thanks, Dave. The stock markets around the world have responded pretty well on the heels of 2023's performance. At the midway point of this year, the S&P 500 is up 15.29%. The Dow Jones is up 4.79%. Global stocks ex-US are up 5.39%, and small cap stocks are up 2.29% across the globe.
So, Drew, that's quite a disparity between the S&P 500 and non-S&P 500 stocks. What do you think might be behind that?
Well, Dave, thanks for the observation. And the reason began a few years back, really accelerated last year, and has continued to be exacerbated this year. And the reason is the concentration effect at play in the S&P 500. Because the S&P 500 is a market cap weighted index, the largest stocks have the biggest impact on returns. The largest stocks in the S&P 500 are trillion or multi-trillion dollar companies. In fact, the top 10 stocks make up now 37% of the entire market cap weighting of the whole index. That, you can see, is at a huge multi-decade high, comparatively speaking. Back in 1996, we're looking at about 17% or so that the top 10 stocks made up in the index. So a much, much different perspective than at that point. And that might not be that big of a deal if they contributed their fair share of the earnings. But as you can see on the screen, they're contributing only 26.8% of the earnings. So they make up 37% of the index, but only contribute 26.8% of the earnings. In addition to that, those top 10 stocks are much, much more expensive than the other 490 stocks in the index. So while it is nice at present that those stocks are doing well and contributing to quite nice positive returns for the index, it is likely going to become some form of an issue down the road as this concentration effect becomes very, very pronounced and the other 490 stocks become quite discounted at present.
So, why is that valuation disparity a concern to investors?
Thanks, Dave. The valuation disparity is a concern because it contributes to the overall valuation of the S&P 500. And as you can see on the screen here, over the last 20 to 30 years, you can see that the S&P 500's valuation as measured by its forward price to earnings ratio has only been as high as it is now a handful of times. At the end of June, marking the end of the second quarter, the forward price to earnings ratio was 21 times forward earnings. Again, as measured by this ratio, only experienced a handful of other times, last notably in 2021, and then also back at the dot-com bubble period. So that is a concern in general because buying an expensive market is a predictor of future returns. As you can see here on the screen as well, using some advanced statistics, you can predict your forward returns over a 5-year basis based on your starting valuation. And with a starting valuation of 21 times earnings, you're really looking at a sub 5% expected return annually over the next 5 years. That is significantly lower than the long-term history of the S&P 500. Now, of course, that is based on forward earnings estimates. Now, that, of course, comes with a question mark, and that's really where the fulcrum point might exist. The market might be fairly valued, overvalued, or even cheap if that E in the price to earnings ratio is substantially different than what they're estimating. And that's really where the forward view can differ. And what I would also posit is right now, earnings estimates look pretty good. And if they were to outperform, this valuation issue might not be as much of a concern. What you're seeing here on screen is that earnings estimates over the remainder of this year, next year, and into 2026 are estimated to grow at 11, 14, and 11% respectively, which are pretty strong growth rates. And if those were to surprise to the upside, then we would likely have less of a concern on the valuation side. So at the end of the day, valuation is extremely important, but we have to kind of allow for some wiggle room in what that looks like.
So, what about other asset classes?
Other asset classes, like the last few years, have been pretty volatile. The interest rate environment this year, while the Fed has not officially changed interest rates, has certainly led to bond volatility. This year, at the midway point, bonds in aggregate are negative, a little bit less than 1% to the downside. Other asset classes, though, especially commodities, have led to the upside. Gold, notably, is up almost 13%, as many other metals are in the general commodities complex. And so notably, alternative investments, as you see on the screen here, can be a pretty good diversifier and complement to a diversified portfolio, especially when bonds aren't taking the place in a portfolio like they have before. However, with that being said, bonds are still quite the question mark in the forward-looking view because of where yields are today and because of that path of interest rates in the future that we talked about before. So a diversified portfolio all across the board and all across asset class is really important and will remain so moving forward.
Any final thoughts you'd like to share with our viewers, Drew?
Thanks, Dave. Investing is, of course, integral to the financial planning process that we use here at Green Wealth Management Group. And as fiduciaries, we're constantly monitoring the market conditions and economic situation to make sure that the portfolios are finely tuned for what we view as risks and certainly opportunities to those client goals. For our clients, thank you for viewing today. We look forward to answering any questions or hearing any comments about our video today. For those of you who we haven't met yet, we're looking forward to our first conversation. Thank you again, and until then.